Hey, what's up? So I came in here today on the weekend because I was thinking about actually making a video about why the rich don't have to pay taxes. But as I was doing it, I was like, man, we skipping past the important part because I already know nobody really does this kind of content right in a way where people are actually understanding. It's either accountants who know too much, talking about it at too high of a level, or it's like the gurus who don't really know enough telling you like the bits and pieces of how they know. So I'm gonna actually give you the how taxes work video, and I'm gonna hopefully give it to you in a non-boring way that you can actually understand. Now, it is accounting and tax info, so bear with me if it gets a little bit technical, but I'm gonna try to keep out of the weeds on this one. I will be looking down at my notes a little bit more on this one because I am teaching something, so it ain't all opinion and ideas. I'm gonna actually make sure that I get through some stats, but everybody knows you have to pay taxes. Everybody also knows that there are people who don't pay taxes. Everybody knows there are ways that you can save on taxes. The problem is nobody knows how to actually do any of that stuff. So that's what I'm gonna cover here in this video. But before I get into the video, I'm Albert, or Albert CPA, or Albert C. Hurston Jr., CPA, CEO, founder, owner, Right Choice Accounting Solutions. Oh, I skipped past the important part. Albert the CPA. Follow me on Instagram. Subscribe here. But owner, founder, CEO of Right Choice Accounting Solutions, your one-stop shop accounting and tax solution. I run it with my amazing, gorgeous, spectacular wife, Lauren, and our amazing team. We are your one-stop shop again, bookkeeping, tax, fractional CFO, tax strategy, any of the things that happen in the accounting atmosphere, we do it here at Right Choice. And we also have the business owner's financial playbook for people who are not ready to work with a company like us, but definitely want to learn how to start leading their business by the numbers. All right, now that that's said, let's dive into the actual video. Okay, let's get into the most important part, income. Taxes start with compiling all of your different sources of income, right? And there are two main sources that most people need to understand. You got ordinary income, which is going to be like business profits, W-2 income, and just regular income that you're getting. And then you got capital gains, which comes practically from the sale of assets. These are the two types of income, and you want to understand the difference because they are treated differently. And since the common one that everybody will pretty much relate to and have is ordinary income, this is the one that is subject to the tax brackets, the tax rates, and all of that stuff. Capital income or capital gains is treated a little bit differently, so I'll handle it. I'll handle that one later on in the video. But let me get into how ordinary income actually works. So again, ordinary income is going to be that income that you get just from running your business and making profit or just getting your paycheck. That's just a quick reiteration. But if you are a business owner, your income just works a little bit differently, right? It's a few things that you need to consider that most people don't have to consider. The big thing that I think catch a lot of business owners catch business owners off guard is going to be self-employment taxes. Because if you have a job, that's pretty much managed through payroll. But for business owners, there is 15.3% of income, taxable income, that has to be withheld and paid. And this trips a lot of business owners up because they don't know they need to be withholding this. They know income taxes, they know state income taxes. Very few people know that they need to be actually handling the self-employment tax. And all self-employment tax is social security and Medicare. So Social Security and Medicare, the total that has to be withheld is 15.3%. The difference is when you have a job, the company withholds and pays half, and you as the employee withholds and pays half. As a business owner, you have to pay the whole thing. Now it is offset later, but we'll talk about it a little bit later. It's offset against some of your adjustments to income on a tax return, but you are responsible for knowing and withholding it. Another big one for business owners that W-2 owners don't have to worry about is going to be QBI. And QBI, Section 199A, in Section 199A, is up to 20% of qualified business income is deducted before taxable income. That's just the 20% business deduction that you get just for being profitable and being in business. I think those are the main two. And I do just want to add, because I don't want to go through all my notes. I'm a nerd, y'all. You all know it's too much in these notes for me to read. And I said I'm not going to get highly technical. So if it gets a little bit awkward, that's because I'm reading stuff on these notes and I'm not going to say it because I don't want to waste your time. You know how I would feel if I sat there and saw you yawning while I'm trying to teach you this stuff. This important stuff. Anyway, get back to it. Now, for business owners, the difference between W-2 and business owner, you do get to deduct your ordinary and necessary expenses. So all those things that you're doing in business that literally help you grow business, without getting too crazy, I'll just say the ordinary and necessary ones. So we talking marketing, we talking team, we're talking softwares, we talking overhead, office expenses, and all of the things that help you run your business operationally on a day-to-day. You get to subtract those things out before taxable income. Whereas if you just have a job, you don't really get to subtract out anything. So that's a big perk of being a business owner. That's why a business owner, and that's why a lot of business owners are able to, create tax strategies and tax plans that allow them to pay less in taxes. But we're not talking about saving on taxes so heavily. We are talking more about how taxes work. But the next section I'm going to get into is a low-hanging fruit tax savings area. So I want to make sure I give it at least a few minutes before I move forward. Okay, man. So let's talk about it, because this is something I feel like everybody should be doing, because this is one of the things where you get to write it off and you get to actually keep the money. So it ain't a lot of things in life that's a win-win. The only thing about this is it's not timing, so you don't get to spend the money. You get to keep the money, but you don't get to spend the money. I'm talking about retirement accounts, right? And I always say it's the low-hanging fruit because it's one of the few things that you actually get to show your income on paper. And before you get to your taxable income, the amount that your taxes are calculated on, you get to subtract this stuff out. So yes, I'm talking traditional 401ks. I'm talking SEP IRAs for my business people. I'm talking traditional IRAs. And I'm going to actually give you the amounts because I wrote them down here. So I have them. And y'all let me know in the comments, because y'all see what I'm doing here. I'm trying to keep it engaging and entertaining, but I do want to give you good information as well. So if you want to, or if you don't want to embarrass me, if it's just trash, go on and shoot me the email, because we don't want everybody to start piling on in the comments. But if you like me going through this, just tell me if I'm doing a good job of keeping it light and interesting, or if you would have liked if I would have done a little bit more of a deep dive. But anyways, just keep that in mind as you're listening to the rest of this. The pre-tax amount. So on traditional 401ks, this is for 2026. So taxes that'll be filed in 2027. For 2026, these are the updated numbers. So for your traditional 401k, you can do up to $24,500. That's the limit at ages 50 and up. You can add a $8,000 catch up, which means you can do 32.5. I think that math is right. At ages 60 to 63, can do 11,250 instead of the 8 catch up. So 24.5 for most. 24,500 for most people, or people under 50. If you're 50 and up, you can add 8K to that. If you're between 60 and 63, you can add 11,250 as catch up. Self-employment, not self-employment, self IRAs for self-employed people, you have a $72,000 limit. Now, that has to be calculated. It can be more than 25% of income, but it's up to 72,000. Traditional IRA, we have a $7,500 limit for 2026, and of course, up if you're older than 50 or 50 or up, you get an 1,100 catch up for 8,600 total. And I will mention Roth. I wrote down Roth. I don't like mentioning Roth in this section because it's not a tax savings. It doesn't work the same way, but Roth is after tax. So the growth is it grows tax free, but when you contribute, it's not tax free. So it doesn't help you save on taxes on the front end the same way that the other retirement accounts do, but it does allow you to save on tax growth if it grows over the years. Okay, let's take a deep breath. That's a retirement account. So just to make sure that we're staying on track, because I know it can be heavy stuff, but we need to understand this stuff. So just real quick, what we are in the tax calculation. So we're starting with income, all of our different sources of income. We talked a little bit about, ordinary versus capital. I'm going through the ordinary income calculation right now, and we'll get into capital later because it's a lot more straightforward. So we've discussed ordinary income, compiling your income. We've discussed some perks of having a business, and now we're discussing the low-hanging fruit, because these things are all happening before your taxable income. because we want to make sure that we lower taxable income without necessarily lowering income, because income is what is used for you to qualify for stuff, blah blah blah. Taxable income is what's used for you to your tax calculation for what you pay. So moving on into the types of deductions, right? We have the standard deduction and we have the itemized deduction. So once we get through all of the retirement stuff and the stuff that I just mentioned above, it's two different paths. So standard deduction is what almost 90% of people think. The last time I looked it up, I think it was like 90% of people take the standard deduction. It's a set amount. The amount for 2026 is $16,100 if you're single, $32,200 if you're married filing jointly, $24,150 head of household, and if you're married filing separately, you're gonna follow the single 16,000. So most people just take that deduction. So that's a deduction off of your income before your taxable income is actually calculated, and every single person who filed gets it. Now, people who do like a lot of not a lot of itemized, but a lot of expenses that can be itemized, sometimes you can beat the standard deduction by itemizing. And I know you probably heard standard or itemized before. This is what it means. So itemized is where you add up the real expenses. It's like mortgage interest, your state and local taxes, up to 40,400 for 2026. Your donations, a lot of people donate a lot because they want to itemize, and we have to tell them, look, if you're not donating more than just the standard deduction, like you don't want to donate 10,000 for the write-off. Now you can donate 100,000 and it'll help you, but if you donate 10,000 or even 20,000 if you're married filing jointly, do it for the love, not for the write-off. You will have to donate more than a standard deduction for it to make sense. And then when you're considering standard versus itemized, whichever one is bigger is the one that wins, right? So if you have you married filing jointly, you got a 32 standard deduction, and you just so happen to have 35,000 in itemized deductions, you just take the itemized and you win. But you want to make sure that you're doing both. If you play the game where you contribute some stuff, you have a mortgage interest, you have all of this stuff, always urge your tax preparer to do both just to make sure, because a lot of times tax preparers will be lazy and they'll only consider like the donations and the charitable contribution. But sometimes like that 15K charitable contribution, when you add it in with the other stuff that can be itemized, it actually does put you over. So a right choice, we always make sure we do both just to make sure that we're covered. All right, I'm not going to do another rundown, but we're right here, y'all. We're right at all of the stuff that happens before we get to taxable income. And taxable income is the main number for ordinary income, because this is income minus adjustments, minus deductions, including QBI if you're a business owner, and that's what you get to your taxable income. So everything that happened before taxable income is just going to be really what we used to get the taxable income, and everything that happens from here on out is what you actually owe. Okay, I know I said I was gonna keep it real quick and to the point, but I do want to talk about marginal and effective tax rates just real quick, because you don't actually owe what you think you owe. I used to hear people say, I'm in a 37% tax bracket, I'm in a 40% tax bracket. A lot of people think that means that you actually pay 40% on all of your money, and that's not what it means, right? So your marginal rate is what you typically hear people talking about, and that's the rate you pay on like your next dollar. So if you are a millionaire, you probably in the highest tax bracket. So let's just say you're a millionaire, you in a 37, 39% tax bracket, whatever it is, because I don't want to get too specific. But that's only once you've walked through the tax bracket. So your effective rate is actually the percentage of what you owe. And I like to demonstrate by just using two people, because as you know, the standard deduction matters, the filing status matter if you're single, married, filing jointly, blah blah blah. So let's just say we have two people, both single, both 30 years old, both take the standard deduction. So one of them makes $50,000, one of them makes $500,000. On that $50,000, because I'm not gonna get too much, we have to take out the standard deduction and all that crap. We won't do all that. Just for round numbers, for that first $50,000, they have the same tax situation or scenario. They pay the same amount. So that's how tax brackets work, right? So it's for the first 50 or the first batch, the first group of numbers, just to, again, I don't want to get so technical, but it's hard. Y'all, my nerd is trying his best to like kick out. It's like, tell them the numbers, tell them the numbers. But I already know your brain may be like, yeah, tell us the numbers. But the moment I start spewing a bunch of numbers, y'all, you gonna feel that sleep kick in. You're gonna be like, man, did I eat? I got the itis. Anyway, so I won't do it. But let's just say the first, for any two tax scenarios, the first batch of the first group of the first amount, Jesus Christ, I'm trying to think. The first bracket, I was trying to avoid saying bracket, but the first bracket, let's say it's 0 to 10K. That's taxed the same. The next 10 to 50K taxed the same. The next 50 to 100, 50 to 200. Like all of that stuff is taxed the same, and you just kind of fall off. So if you only made 100, you stop there. But if you make more than 100, it keeps going and it keeps graduating through the tax brackets. So somebody who's in a 40% tax bracket or 39% tax bracket, that doesn't mean they paid 39% of all of their money. They just passed the bracket and started the bracket. So the money that they started earning at a certain point was taxed at 39%. So they already walked through, 0, 10, 12, 20, they already walked through all those. But those numbers, as they were in those brackets, are just being taxed at those percentages. I hope that makes sense. And again, hope it wasn't too boring. I'm gonna keep saying that because maybe that'll keep you engaged and entertained. Anyways, I'm gonna go ahead and move into the capital gains. So let me review these and I'll be right back. Okay, I changed my mind. I'm not gonna review it and come back. I'm gonna just look at the notes as I'm going through it. So, because investment gains are taxed differently than ordinary income. So, investment gains are practically just a percentage of what's earned. So it doesn't go through the tax brackets. There aren't any deductions or that sort of thing. The thing that you have to understand about investment gain is pretty much how long. So short term just means it was held less than a year. That's going to be taxed just like ordinary income. So it does go through the ordinary stuff. Because if you do it for less than a year, it's not really a true investment. So the IRS has dictated that you don't get investment perks for just buying an investment and selling it quick. So that's ordinary income. But when we get into long-term investments or over a year, that's where we get some of the beneficial tax rate schedule. So that's going to be 3 rates, right? 0, 15%, 20%. And I will give you the 2026 number. So it's 0% up to 49,450 if you're single, 98,900 married filing jointly. So if you sell an asset, a long-term asset, 0% tax rate up to 49,450 if you're single, 98,900 married filing jointly, 15% up to 545 single, up to, I keep on estimating the numbers. Let me say the real number. 545,000, 545,500 if you're single, 613,700 married filing jointly. So the first up to 613,000 if you're married and you file with your spouse is taxed at 15%. Now, if you were to go over to the other ordinary income rates, you already know it'd be taxed at a much higher rate than that. And then it maxes out at 20% above that. So if you make $5 billion in capital gains, you're only paying 20% as opposed to the highest tax rate for the year. So the real, I guess, line is going to be timing. It's going to be, you want to hold your investments for over a year. And I'm getting to the end, y'all. I really want to know how I did here. This is a highly technical video, and I think I gave you everything you need, outside of getting too into the weeds, because the goal is for you to understand how this stuff works, right? So I will give you just a quick, before we get out of here, I will talk about deductions and credits, and I will run you through the full ordinary income calculation again. So let me just run through it. So deductions they will offset your taxable, let me say it right. So deductions reduce taxable income. Credits reduce your actual tax bill dollar for dollar. So a tax deduction, let's say you got a 10K deduction, that's going to save you, whatever tax bracket percentage. So if you're let's just say 20% for easy numbers, that's not a real tax bracket, But let's say you got 10,000 and you are in a 20% tax bracket, that will save you 2,000, I think. Yes. Yes. Again, it's the weekend, so if I ain't as sharp as I need to be, y'all gonna have to give me grace on this. But that will save your tax percentage of the actual amount. But on a credit, on the other hand, if you got a $10,000 credit and you had a $10,000 bill, it will literally save you 10,000. So tax credits are, always the gold standard for saving. And just before we get out of here, let me give you this full tax equation one more time. So we got, matter of fact, I'm gonna make sure I don't miss anything. Let me scroll back through. So yeah, I'm gonna add on to it. So the complete tax equation is going to be income minus adjustments minus deductions. That equals your taxable income. Taxable income is then walked through the federal tax brackets. So that means it's going to go through all of those tax brackets, the 10%, the 12%, the 22, 24, and on up, and to calculate the taxes due. And then to piggyback, the state taxes are going to follow that state calculation. The states all have their own thing going on, so I won't try to walk through tax brackets. It's a little bit simpler, but it typically follows the federal tax percentage or taxable income amount. The percentage is much lower, thank God, but it follows the federal taxable amount, and you just use that to calculate your state. And there are some tax-free states, as you know. I'm gonna list them here just in case you're thinking about moving. We got Alaska, we got Florida, we got Nebraska, we got New Hampshire, we got South Dakota, Tennessee, Texas, Washington, and Wyoming. So if you're thinking about moving, you may want to think about those places. I know most people think about Florida and Texas, Florida, Nevada, and Texas, but there are some others on the list that, if you want to do something different. I'm from Alabama. I live in Atlanta. Tennessee looks a little good from time to time, but I ain't gonna do it. Anyways, I think that's it. One more quick scroll through the notes. Yeah, I think that's it. So now just watch this a couple times if you need to. I try to not make it too long. I try to not make it too technical. But yeah, you just want to compile all your income, know that stuff. You want to make sure that your ordinary is separated from your capital, and you see how both of those are treated. If you want to just write down notes too, because I'm rambling a little bit, I think, just so I'm not being too technical, but just to make it clean. You want to compile all of your sources of income. You want to understand the difference between your ordinary and your capital. You want to know which adjustments you actually qualify for. You want to get into just contributing to your retirement, because that's just low hanging fruit. Like I say, you're taking your $50,000 and you put it in a retirement account, and hopefully that retirement account will grow. But it's still your $50,000, and hopefully it's growing. So you get to keep your money, and you get to write that off. It's not a write-off, but you get to offset your taxable income, and you just really can't beat that. You want to understand your taxable income, and once you can understand those things that go into taxable income, after that is just a calculation. And again, with capital, you just want to hold that stuff over a year, and after that, it's just a calculation. Capital taxes are only applied once you sell. That's important to know. So you can hold it forever. And the wealth building tip, I'm gonna get into that in the next video. There was a point of me doing this. It was for the next video that I'm doing. But the wealth building tip is you ain't really got to sell your capital assets. You can use them and leverage them and actually borrow against them. So you avoid income taxes on that. But again, different topic, different video. So now, I don't like talking about this, as you know. I do not want you guys to see me as one of these tax guys. I don't want to spend a lot of time talking to you about tax savings and tax tips and all of this stuff, because there are so many other things to talk about, especially when you're growing and scaling a business. I'm here to help, but I actually have a team that does that stuff, so I don't want my content to be that. And again, y'all know, man, if y'all see the guys, y'all know it just look a little sketchy and stuff, and I don't like that. I like to work with clients one-on-one to build out strategic plans. So that's why I don't talk about tax tips and tricks and all that stuff a lot. But it is important for me. It's important to me that people actually know this stuff. So that's why I'm talking about it here. But I might not ever talk about this again, or I may do it annually, because again, I just ain't one of these tax influencer dudes. I don't want you to see me that way. I'm a CFO all day, every day. I make those numbers talk. So we talking strategy, we talking scaling businesses, we talking leveraging. We talking about the big picture stuff, not like saving on no taxes all the time. All right. All right. Now I'm rambling. I'm gonna get up out of here. Get this book if you are somebody who really just wants to understand how to stop guessing and start leading by your numbers. This book was a 300, I can't remember that. It was over 300 pages. It was a textbook for CEOs. And then I wait, CEOs ain't finna read no textbook on accounting. So I jumbled all of that information down to under 100 pages just so that you specifically can understand how to run your business by the numbers you need to know, how to find them, how to hold your actual accountant's accounting. This empowers you to be a real leader who leads by the numbers. Of course, if you're someone who is looking for that one-stop shop solution, make the right choice. I know I ran through it at the beginning, so I won't do it again. Here, we're one-stop shop. So everything that you would need your accounting team to do, our team does it here at Right Choice. Follow me at AlbertTheCPA on Instagram. Check out The Real Bottom Line with Albert the CPA. We have a show. We have a show where we actually kind of hit current events and topics, where we actually add numbers to some of the stuff that people are discussing. We play a game. We have an Ask Albert the CPA segment that you can actually participate in. Shoot me an email at askalbertthecpa@gmail.com, and maybe your question will be answered live on the show. And that's pretty much it. So we got to do the YouTube thing. Like, comment, subscribe. Let me know what you think, and let me know if you actually like this comment style. As I'm taping, I feel a little weird about it because I hovered around the stuff, but I never got into the weeds of the stuff. So just let me know how you feel about that, and I'll be looking forward to hearing from you, and I'll be looking forward to seeing you in the next one. Have a good one.